The second part of this chapter deals with accounts receivable. You should already be familiar with what an accounts receivable is. It's an asset, a current asset. It's monies that we expect to receive from our customers. And we have accounts receivable when we sold goods or services on account, or also known as on credit. So when we provided services or goods to customers but they did not pay us cash at the time they got their product, they're supposed to pay us cash later. So the company is extending credit to their customers. That's how we result. That's how we have accounts receivable. So it's a fact of business that anytime you extend credit to customers, there's going to be some customers who end up not being able to pay you, right? That's just a fact of business. Legally, you're entitled to receive those, and the customer really does owe you that amount, but for whatever reason, some customers may go bankrupt, some customers may just not pay. Some customers, if they're another business, that business may go out of business and you're just not able to collect from them. So management is going to have to decide on a credit policy that they're comfortable with. The more lenient the credit policy, the more likely your sales revenue is going to go up. Because if you extend credit to everybody, no matter what their credit history is and their likelihood of paying you, then your sales revenue will go up, right? Your sales volume will go up. But then also, with that, if you're very lenient, you can expect there's going to be a lot more people who's not going to pay you that cash. So management's going to have to decide the credit policy to strike a balance between maximizing their sales and minimizing the accounts receivable that are never paid. Okay. It is very important. I want to stress to you that if you have not been reading your chapters, it's very, very important. It's always important to read your chapters, but it's critical that you read very carefully the sections of this chapter dealing with accounts receivable. I think it's one of the most confusing topics that we talk about in accounting. So I'm going to try to break it down easy in simple terms, but it is confusing. So make sure you go back and read that part of the chapter dealing with accounts receivable. With accounts receivable, we apply the matching principle. And we talked about the matching principle in chapter 3. The matching principle says that we want to match the expenses with the revenue that they help generate. We want to put those expenses on the same income statement with the revenue that it helped generate. So with accounts receivable, we apply the matching principle. We want to put the expense of having some customers that don't pay us, because we know if we sell products on credit, there's a chance that some customers won't pay us. So that's an expense of the business. We want to put that expense of having customers who are not going to pay us on the same income statement from the revenue that was generated from those sales. Okay, that's the matching principle. We saw it in action in chapter 3 when we recorded depreciation. The depreciation, we recorded depreciation expense over the time that we used the asset. That's matching principle in action. We also saw it when we recorded supplies expense. Supplies are going to sit on our balance sheet as an asset until we actually use them up. And so when we use them up, we want to match the supplies expense with the revenue it helped generate. So in all of chapter 3, really, all of those adjustments, the adjusting prepaid insurance and recording an insurance expense, that is matching. We're matching that expense to the same we're putting it on the same income statement as the revenue it helped generate. So let's talk about a year. I think it's easier to put real numbers in. So if we're talking about sales volumes for say 2014, We had all of these sales in 2014, and we sold some of them on credit. So we're going to have accounts receivable for 2014. If we're getting ready to prepare our income statements and our balance sheet at the end of 2014, we know we have accounts receivable from sales that we made in 2014. And we know that some customers won't pay us. But we don't know exactly who's not going to pay us. We just know that some of those will not be paid. But there's no way to identify which customers are not going to pay us, because if we could do that, we just wouldn't extend credit to those customers. So at the end of the period or the end of the year, you're going to have to, the management is going to have to estimate the amount that will not be collected, because we don't know. There's no way to know exactly who's not going to pay us. It's got to be an estimate. And we have used estimates in the past, and so that shouldn't bother you too much. A lot of accounting is estimates. If we don't know an exact amount, we have to estimate it, because we know it's going to be an expense. We just don't know exactly how much yet. So I'm trying to think of where we've seen estimates so far. I know in depreciation, that involves using estimates. Remember the formula for depreciation? We had the cost minus the salvage value. Well, the salvage value is an estimate. It's management's best guess at what that asset will be worth at the end of the year. And we also used a useful life, the years that we think we're going to use that asset. That's an estimate. We don't really know for certain how long we're going to use the asset. It's an estimate. So we do have to use estimates from time to time. And this is a case where we will have to use estimates. So when we get ready at the end of the year to make our entry, this is what it's going to look like. We're going to record bad debt expense. Bad debt expense. That's a new terminology. Bad debts are those accounts receivable that we're not going to be able to collect. So the bad debt expense is the expense of our customers not paying us what they actually legally owe us. So we have bad debt expense. We want this expense to fall on the same income statement as the sales it helped generate. So when we sell items on credit, that's generating sales. We want this expense to fall on the same income statement as those sales, as that sales revenue. So that's the expense, but we have to have something to balance this equation, and we're going to use another contra asset account. We have already used one contra asset account. This is our second contra asset account. It's allowance for uncollectible accounts. Okay, and then that's gotten this. Let me fix this. So our other contra asset account that you've seen a little bit of was called accumulated depreciation. Remember, it reduced the amount of assets. It's a contra asset, so its natural balance is always a negative, whereas most assets are, the natural balance is a positive. This is going to be used to reduce our accounts receivable. So this is the entry that we'll use, and we've got different methods on how to calculate the numbers that go here, and we haven't got to that yet. We're going to get back to that. I just wanted to talk about the entry first. That's the entry that you'll make. Now, how will this be reflected on our balance sheet? What will this look like on our balance sheet? So let's look at a balance sheet. Notice this is not a balance sheet up here. This is not a balance sheet. This is the accounting equation. It's also known as our books and records. We use everything that's in the accounting equation to prepare a balance sheet. But our balance sheet, again, you should be very familiar with what a balance sheet contains. It contains our assets, a list of our assets, a list of our liabilities, and a list of our shareholders' equity. You had to prepare one of those last exam. So under assets on our balance sheet, you know that accounts receivable is actually a current asset, so it would be listed as a current asset. We're going to have accounts receivable listed. And now we're going to have a reduction to accounts receivable for this allowance for uncollectible 10,000 and 2,000. So this gives us our what's called net realizable value, and that is 8,000. So this is the entry that you would make to record that bad debt expense. Bad debt expense is the expense of having customers who are not going to pay you. They legally owe you, but some customers just won't pay. We're going to estimate that expense at the end of the period and record it as bad debt expense. The corresponding adjustment will be to the allowance for uncollectible accounts. And this is how it would look on the balance sheet when you list your accounts receivable on the balance sheet. You're gonna say accounts receivable. This 10,000, that is the amount that your customers owe us. The full amount that our customers owe us. They legally owe us 10,000. 2,000, the allowance for uncollectible accounts, is what we believe we're not going to collect. It's our best estimate of the accounts receivable that we're not going to collect. Our best estimate. It's an estimate because we don't know for sure exactly who's not going to pay us. The difference between the numbers is called our net realizable value, and that is what the company actually expects to collect. And that will appear on the balance sheet, what we actually expect to collect. We're legally owed 10,000, but we know that some customers won't pay us. So this is our best guess for what we actually receive. Okay, and I just made these numbers up to plug in real numbers. But we're going to talk about how to get our numbers in just a little bit. I want to see if there's anything else I need to say. Okay, I think that gets us. You should have your textbook open because I will refer to your textbook in just a moment. Now, so that gets our accounting entry in our accounting equation and how it's reflected on our balance sheet. So this number will go, this allowance for uncollectible accounts will go on the balance sheet, right? On the balance sheet as a contra asset. It's going to reduce our assets value. This bad debt expense is just like all the other expenses that we've learned, is going to appear on what financial statement? The income statement. Okay. Now let's talk about how to calculate the amounts that go here. I put in X's. There's two methods that we can use, and management will have to decide which of the two methods it wants to use. There's either the percentage sales method, percentage of sales, or the accounts receivable method. And I thought I had my lecture. Let me see if I can pull up my. Just a second. See if I have my lecture notes here so you can see. I'll just write them. The two methods are percentage of sales, or sometimes it's the percentage of credit sales. So the focus there is how much of our sales will go uncollected, right? The percentage, and management would have to make that call. And the other method is called the accounts receivable method. It can be a percentage of accounts receivable or what's called an aging schedule. The percentage of sales method is definitely the easiest method. So if management wants to use percentage of sales, they would have to come up with a percentage based on past experience or industry standards, industry averages. But they're going to come up with a percentage. It may be like 1% of sales or 2% of sales, and that's going to be the bad debt expense. So if it was 1% of sales, you would take 1% of whatever your sales figure is, and that is the amount that would go here and here. Okay? The accounts receivable method looks at how much of your total amount of accounts receivable will go uncollected. You can either use a percentage of accounts receivable. Again, it could be, management could say, 2% of accounts receivable or 3% of accounts receivable is what we believe we will not collect. Or what's typically used is an aging schedule. Look on page 165 of your textbook. And the graph that's on page 164, sorry, I think I said 165, 164 of your textbook, this is an aging schedule. It lists all the customers that actually owe the company money. It lists all of your accounts receivable. So if you look here, the total amount that customers actually legally owe is $43,450. Some of those are current, which means they're up to date. They're not past due. 25,500 of those. I'm on the third line from the bottom. 25,500 of all of our accounts receivable are actually current, meaning they're not past due. And then we have the past due amounts. There's 10,500 that's 1 to 30 days past due. 3,000 and something that's 30 to 60 days past due, 2,700 that are up to 90 days past due, and then 1,400 of our accounts receivable are over 90 days past due. This is an aging schedule. Now, if you look at the row directly under those totals, you would see the estimated percentage uncollectible. So management has estimated that out of the current amount of receivables, only 1% of those will go uncollected. The management thought 3% of the ones that are 1 to 30 days past due will go uncollected. Now go over to the last column where it says over 90. Out of all of the accounts receivable that are outstanding, the ones that are over 90 days past due, management actually believes that 50% of those will actually go uncollected. And that makes sense, right? If you notice, the percentages are getting higher the more past due the bill is. And that makes sense because most people pay their bills on time, and it probably is your customers who are struggling financially that are late. And if they're struggling financially, it's unlikely they're going to be able to pay. So the percentage of those are going to the percentage of those that are unable to pay or just will not pay go up the more days past due that invoice is. So from that, you can estimate your total amount of past due, your total amount of bad debts. So you take 1%, or 3%, or 8%, or 20%, or 50% of those receivables. And that's how they get the bottom line. The bottom row of this graph is your total estimated bad debts. And based on this aging schedule, it's $2,078 is what management believes will be uncollected. So that was how you would use your aging schedule. And if you were using that method, then you would take that number and plug in here, 2,078. 2,078. The entry is going to be the same no matter which. Let me say this. The accounts that you use are going to be the same no matter which method, which of the two methods you use. Right? You're going to have a negative number for allowance for uncollectible accounts, and then also a negative number here for bad debt expense, regardless of if you use the percentage of sales method or the accounts receivable method. The only thing that would be different between the two methods is the dollar amount that goes here. I'm using the number that's based on the aging schedule, so that's considered an accounts receivable method. The number would be different if we use the percentage of sales method, because we would just take the percentage, whatever management thought, say it's 1% of sales. If it's 1% of sales, and we had $100,000 of sales, for instance, then that would give us $1,000 bad debt. So, that's how percentage of sales method is a lot easier than the accounts receivable method. But you do need to know both, and it would depend on management. Now let's see. Now let's look at, so this is the entry that we make at the end of the year when we want to estimate our bad debt expense. Now let's look and see what we do when we actually determine who is not going to pay us, when we actually know for sure that a customer is not going to pay us. I'm on page 166 of your book if you want to follow along. So we made this estimate at the end of the year, and that was our best guess of how many accounts receivable were not going to be collected. Now, let's assume that we know for sure one customer is not going to pay us. Let's say he filed for bankruptcy and we just know we're not going to get paid. Now, this is the entry that you would make. You would remove, if his balance of accounts receivable was $600, you would remove that from accounts receivable. Okay, and I'm going to just use the customer that's in the book, Dibs. If we found out that Dibs was not going to pay us, we would remove his account completely from accounts receivable. And look, we're also going to remove it from our allowance for uncollectible account. So this is normally a negative balance, so to remove it, you make it a positive number. Okay, let me see. I want to say this is what we do to write off a specific account. We only write at the account, to write off a specific account. We only write off a specific account when we know that customer is not going to pay us. And this is going to be, say this was in 2014. Well, we're going to go ahead and estimate that bad debt expense so that it shows up on our 2014 income statement, right? And we don't find out for several months that this Dibs is not going to pay us. So let's assume it was March of 2015. When we find out in March 2015, this is the entry we make. That bad debt expense was already recorded and reflected on our 2014 income statement. But we don't find out until later that he's not going to pay us. So we remove it. We remove his account from accounts receivable. He legally owed us $600, but we know he's not going to pay us. So we're going to just take it off of our books. And then we also take it out of allowance for uncollectible accounts. Notice there is no bad debt expense when we learn that somebody's not going to pay us. And we can't count it as bad debt expense here because we already included it as part of this estimate. Remember, this is the estimate of who's not going to pay us, and here we have somebody that's not going to pay us. So you do not record the expense when you write off a specific account. That expense was already recorded when we estimated who was not going to pay us. Now look on page 166, or I can do it here as well. I want to show you that this does not have any effect on our total accounts receivable. Let me use our numbers here. I'm going to use the numbers out of the book. 43,450 and we had estimated that 2078 was going to be not going to be collected. So our net realizable value was 41,372, right? And this was prior to the write-off. And then when we wrote the account off, we removed $600 from our accounts receivable balance. We also removed $600 from our allowance from uncollectible accounts. And I just wanted to show you that the net effect is going to be the same. If you take this number minus 600, our new accounts receivable balance is 42,850. And our new, if you take this negative 2078 and add 600 to it, our new amount for our allowance and uncollectible accounts, what's in that account, is negative 1,478. So the net realizable value is 41,372. This is after write-off. So after we wrote off that specific account, it had no overall net effect on accounts receivable. We removed it out of accounts receivable, and then we also removed it out of our allowance for uncollectible accounts, so our net realizable value stays the same. Now it gets pretty complicated when you do this, and so we're going to work some problems, but before we do that, I want to give you a formula that may help. You could write it in your book on page 167. It's also in my lecture notes, but on page 167, I think my formula makes more sense than the exhibit they have in the book. So the formula that I think for this accounts receivable method, I would like to use this formula. Beginning allowance for uncollectible accounts minus any write-offs plus your bad debt expense, and that's going to equal your ending amount in your allowance for uncollectible accounts. And this may make more sense after we do a problem, but I just want to have this in your notes. So if you're using the accounts receivable method, you'll use it for some of our homework problems and also for the quiz problems. This formula will come in handy. If the problem tells you the beginning allowance for uncollectible accounts, like what you had on January 1st, and then tells you during the year you had so many write-offs, then you're going to subtract out write-offs. And then if it asks you to determine what the bad debt expense was or what the ending amount of allowance for uncollectible accounts are, this is a formula that will help you. You have to know, is the question asking me to determine bad debt expense, or is the question asking me what is my allowance for uncollectible accounts? So if you're using this accounts receivable method, this bad debt expense is a plug. Which means you just solve for X is what I want you to do. Usually you will know the beginning allowance amount, you'll know what you want your ending allowance to be, and you'll know what your write-offs were. So you'll know all the things other than your bad debt expense. So you have to plug it in this formula and solve for X. Treat this as X, as the number that you don't know, and solve for that. And that will be the amount that you use in this equation. Okay? We didn't have to do it here when I plugged this number in because that was the first year that this company had ever estimated bad debt expense. But for every other year, using this accounts receivable method, you have to take into account any amount that was already in allowance, the allowance account. So when calculating your bad debt expense for most years, other than the first year, but for all other years, you have to take into account the balance in the allowance account. So if you know your beginning balance and then you know your write-offs, see how this is. Like this would be your beginning balance, but then you had write-offs, and write-offs affect this allowance account because it increases it. And this formula already does that for you. So you have to do that. Now for a percentage of sales, you use the same kind of formula, but it's so much easier because you do not have to take into account any balance in your allowance account. So if you ended up, and one other thing I forgot to say here, you will usually always have a ending balance in your allowance account because it's an estimate, so you're not going to estimate exactly right. So you're going to either have for the prior year, you're going to either have overestimated or underestimated, right? Overestimated or underestimated, and that's going to leave you a balance in that allowance account. And for accounts receivable method, you have to figure that out because under the accounts receivable method, this is going to be either the ending allowance is going to either be based on our aging schedule or our percentage of accounts receivable. So you'll be able to calculate that figure, but then you'll have to solve for this plug number to figure out what's going to go into your accounting equation right here. Now, let's talk about this percentage of sales method, and then we'll do problems, which will make it easier, I think, for you to see what I'm talking about. You use the same formula, beginning allowance for uncollectible accounts. Sometimes that's also called allowance for doubtful accounts. So if you see allowance for doubtful accounts, it's the same. It's just another word for that account. Plus bad debt expense. And that's going to equal your ending allowance for uncollectible accounts. This is all in my lecture notes as well. So. Now, with the percentage of sales method, this number, you don't have to solve for X here because it's going to be a percentage of your sales. You're going to be able, the problem will tell you they use this percentage of sales method and management estimates 1% or 2% or 5% of sales. You're going to have to take 5% of sales or 2%, whatever the percentage is, and that will be your bad debt expense. That is the number, the bad debt expense is the number that you use in your accounting equation. Here and here. Okay? You do not have to take into account when you're calculating bad debt expense with this for this percentage of sales method. You don't have to take into account any balance that you already had in allowance. If you will probably have a balance of some sort in the allowance account just because it's based on an estimate, and you in the prior year you would have had underestimated or overestimated a little bit. So you'll start out with a beginning allowance account amount. So use this formula. For this method, you usually have to calculate. The problem will usually says what is the ending allowance for uncollectible amount accounts. So I will now do a problem to help make this a little more clear.